Welcome to Wall Street Week, the show of record for long-term investing. I'm Anthony Scaramucci.
And I'm Gary Kaminsky. Friday morning, the business world was watching two huge events, Hurricane Matthew and the September jobs report. The U.S. economy added 156,000 jobs last month, while the unemployment rate ticked a little bit higher to 5%.
The next jobs report comes the Friday before Election Day. So what does this mean for your money? And does this change anything for the Fed? Our special guest is Steve Einhorn this week. He's the vice chairman of Omega Advisors. Steve, what do you make of all the jobs numbers this week?
Well, I guess first and foremost, any one report has to be taken in context. It's a variable, volatile number. Having said that, I would characterize the report as a reasonably good one. While the headline number was a bit weaker than expected, the private sector employment increase was in line with expectations. There was some lift in wages, which is good. The participation rate, number of folks re-entering the labor market, moved up a bit, which is encouraging. So I would say it's a good report, one that likely will allow the Federal Reserve in December to lift interest rates.
The full-time number was a little weak, though, in terms of full-time jobs. And so I'm just wondering, you think of the quality, the mixture of the jobs, is that healthy for the economy?
Well, there was some decline in full-time jobs, so one could look underneath the hood and find some weakness. But I think in aggregate, again, recognizing any 1 month has to be taken in context, I thought was okay.
So the Fed moves before Christmas. I just want to make sure we got that out there.
I think in December the Fed moves, yes.
All right, so that'll be 2 interest rate rises last December, this December, and then we go into next year. See, I was thinking about this before we began the show today. Anthony, I've been in the investing world 30 years. You've been in it a little longer, just a little longer. How difficult of a time is it right now to be a long-term investor? You've got all of this noise from the Fed. People come up to me all week. What do I try to do? How do I stay focused? What are your words of wisdom how a long-term investor can continue to run the play but not necessarily be distorted by all of this noise?
I think, in fact, this will sound a bit odd and out of consensus. This is an opportune time for the long-term investor if one can remove themselves from the short-term volatility and at times overly granular analysis of the Fed or the data. If you look back historically, there are several items that are typically present at the end of a bull market, and I'll mention them in a moment, but interestingly and importantly, none of them are present today. So my expectation would be that the in-place equity bull market in the U.S. will persist for quite a while longer, suggesting that for the long-term investor, this is a reasonably constructive period.
So irrespective of the election, though, too, you would say that, right? It doesn't matter who wins the election.
I think the market has built in an expectation. Whether the expectation is correct or not, I don't know.
What's the market's expectation?
I think the market expects, as best I can tell, just talking to a whole bunch of people, is that Hillary Clinton will win. Doesn't mean she will. Doesn't mean that the market...
So you think if Mr. Trump wins, you think the market would sell off into that?
Look, there may be a correction simply because he's less known. Obviously, because he's not a career politician. What would happen thereafter will depend much more importantly on who he surrounds himself with, who his advisors are, what he implements in terms of policy, and what the Congress allows to be implemented. So I don't think we can say in any hard and fast way there is a sustained up or down response to the election. What we can say is, for now, the market understands Hillary Clinton better because she's been in the public eye for 30 years, whereas Donald Trump
Well, that's as Mr. Trump has said. She might have experience, but not necessarily good experience. But the election, the one thing that we will know in 6 weeks from now whether the election is going to impact the stock market or not.
We've got a lot of people on our show over the last couple of months that have said that they don't really think it matters long-term to the market. So I'm curious, it may be a short-term issue for the market, but the bull market story, in your opinion, is still intact.
Well, let's go, Steve, let's go back. You were about to point out, what are the signs that a bull market is ending?
Right. Exactly.
Explain to the viewers, because I think it's incredibly important that you give them...
Gary, take some notes on
Yes,
this.
I will. Yes, I will, Anthony.
There are reliably 5 items that tend to be present at the end of a bull market in the U.S. The first is accelerating and problematic inflation. We certainly don't have that. The second is a central bank, Federal Reserve, which is hostile to the economy, that is trying to curb economic activity. We don't have that. Third is the arrival of recession. Our work would suggest we're in the midst of what will be a very long-lasting, though moderate, economic expansion, so we don't have that item. Fourth, investor exuberance. Certainly don't have investor exuberance. If anything, this has been one of the more hated bull markets of the post-war period. And finally, speculative or bad valuation of stocks relative to interest rates and inflation. We don't have that. So I would submit that those 5 items, which are almost always present at the end of a bull market, the start of a bear market in the U.S., not being present suggests the odds are this bull market will persist for quite a while.
I would agree with 4 out of the 5. The one that I think is very difficult, and you probably have economists split, is the recession for next year. Right. So how do you know, and would you agree with that? That's the one variable.
I'm in Steve's camp, though. I actually think you're going to get this steady Eddie phenomena where you're going to grow not as fast as we would like,
right,
not consistent with post-World War II norms for a recovery, but it's just lasting longer, Gary. That's what I think. So.
Yeah, I think we have a stretched out expansion, maybe 2% real growth, 2% inflation, which is less than the historical trend. And I want to stress, my constructive view on U.S. equities is as much length as it is return. I think the market multiple today is about where it should be, 17.5 times. So I don't expect multiple expansion. What I expect is the market can grind higher in line with earnings growth of about 5%. So it's as much, to me, how long this bull market lasts as to the return itself.
Steve, Omega received a Wells notice. You guys are in a battle with the SEC related to insider trading. Do you want to make any comments related to that before we go to break and then come back and talk about stocks?
This is, as you know, a serious issue, and this case is best served not being tried in the media, so I don't have any comment on the case.
Okay. All right. Listen, we appreciate that. I had to ask that, and so stick around with us. We have more to discuss with Steve Einhorn. Wall Street Week. We'll be right back.